Hello and welcome to interest.co.nz. I'm Janae Tibshirani and today I'm joined by John Lyon for another one of our double shot interviews. Welcome, John.
Thank you.
John is the former Lumley CEO who's founded the new insurance business Ando Insurance. Ando is underwritten by the South African insurance giant Hollard Insurance Company. It started selling commercial insurance just last week and plans to take on the big players that dominate the home, car and contents markets later this year. So, John, what has prompted you to leave Lumley just as it was being acquired by IAG and start a new venture?
Thanks, Janae. Thanks for the opportunity to come along today. I suppose the thing that prompted us to start the Ando business was a reflection after I left Lumley at the merger. I took a bit of time out and looked around the market and looked at all the things that were happening in the industry, and there were about 9 or 10 different trends that are occurring, each one of which is going to have a major impact on the insurance industry. But when you look at all of those together, then it's going to have a phenomenal change effect on how this industry operates. And those are things like the way the value chain is beginning to realign, the capital markets changing, regulation, technology, data, consumer behaviours, demographic shifts, all of that. And the essence for us was we felt that if we can create a business that is very agile and uses the best technology and has got a great culture and has the best people in the market, we can adapt to those trends more effectively than our competitors can.
John, something you've spoken about in the past has been, I guess, the relationship between the reinsurers, the insurance companies, and the brokers, the people who distribute the product. What's happening between these different components at the moment, and how is Ando hoping to, I guess, engage all these different components that make up insurance?
Sure. So what's happening at the moment is that the traditional value chain, if you like, of insurance, of capital that comes through from reinsurers through to insurance companies who use that capital, and then brokers who interact with customers. The essence is about the capital and the customers, and everything that happens in between needs to be as efficient as possible. What's happening now is that as capital markets come under more pressure, with interest rates being low, with reinsurers being pressurized by alternative capital coming through with insurance-linked securities and other forms like that, the reinsurers are now pushing more into the area of primary insurance space. So you've got some of the big global reinsurers are now operating direct insurance brands, and they're in effect competing with some of the insurance companies. On the other side, you've got insurance brokers and broker groups who are buying underwriting agencies and who are taking on more and more of the functions typically carried on by insurance companies as they look to grow and increase their margins and take on more of the value chain. So effectively, from an intermediated insurer point of view, there's pressure coming from one side on the capital side and pressure coming from the distribution side. So intermediated insurers are now under more pressure than they've ever been before. And the opportunity is there for us to create a business that can fill those gaps and fill the needs that are created by this change in a different way. And we believe that by creating a business that's more efficient in being able to integrate those various parts of the value chain, we will be able to get some competitive advantage over some of the more traditional players.
You've mentioned big data being a large part of this. Can you explain to us how you aim to use technology and, I guess, information about people, about consumer behaviour to price insurance and, I guess, to engage with customers?
Sure. So technology and data are linked, but they're separate issues in many respects. But taking the data angle, because that's a particularly interesting one, and typically insurance companies haven't had brilliant data about the customer. They've got lots of data about the risk and the and accident frequencies and all of that sort of stuff, but not an awful lot about of information about the consumer and how the consumer is thinking or behaving. When you compare that with, say, the data that a big retail organization has about customers, it's much richer and gives a lot more insight into how a person thinks and how they buy, and indeed what their risk profile is. And a good example of that is the big retail stores, and you've seen this happen in Australia with the Coles and Woolworths move into the insurance world. Those big companies have got a lot of information about what people do with their money. So they come into a store, the frequency they go into that store, what they buy. And if you take something like if they come into the store and buy fresh fruit and vegetables and health foods, that says something about the risk profile compared to somebody who buys everything that's on special and pre-cooked foods and frozen pizzas and so forth. So that sort of information that's available out there can be very useful from an insurance profiling point of view, so that you can get a better deal to the consumer and get it to the right consumers.
Okay, so speaking of those sorts of partnerships with established brands, this is already happening in New Zealand with Warehouse Money, for example, Trade Me Insurance. Is this something which Ando is looking at exploring some partnerships with established brands already? Yeah,
it certainly is. We don't have specific things to talk about at the moment, but we're interested in talking to people in other industries, particularly companies with good brands that have got some association to insurance, but particularly those companies that have got really good insight into their customer behaviours, good customer data. And there's a whole bunch of things that happen in other industries, and the part of the experience I've had over the last year and a bit when I've been out of the corporate world has been taking the opportunity to talk to people in other industries and learn about what's happening in other industries and thinking about, well, how can we apply that back into the insurance world? So the concepts of bundling is very common in some areas. So for example, if with your electricity supply, you can now bundle in Wi-Fi, and you start thinking then, well, how can you bundle insurance in with other products? The concept of top-up. Typically, the way insurance pricing works is that if you want to buy insurance, you go to an insurance company, you ask, how much is it for my insurance? You don't go and say, I've got $300, how much insurance can I get for this? Or how can you put a proposition to me that'll enable me to satisfy my needs with this amount of money? So there's all sorts of different ways of thinking that we can apply to how we deliver the product, and by learning from other industries. But in order to do that, you've got to break out of the shackles of traditional insurance thinking.
Okay. Just speaking about using the, I guess, data that other companies have got about their customers, do you think we could get to the point in insurance where insurance is actually priced based on what we know about the customer? So for example, yes, say I buy really unhealthy food from Countdown, then you might charge me more for my premiums because I'm an unhealthy person, or whatever it might be.
Look, I think that's quite possible. I think when you look at it, theoretically, all the information that's available out there from the public websites, government websites, from social media, from data that's available to big brand companies, it's theoretically possible to be able to compile a whole bunch of information that gives insight into a person's risk profile. And effectively, that's what insurance is all about, understanding risk and then pricing for it accordingly. So we're interested in exploring how we can get to that point where, by asking 2 or 3 questions about a date of birth, an address, name, whatever, that you're able to then get a whole bunch of information from that basic data set and extrapolate that to get to a pricing mechanism.
I mean, this is an interesting theory, I guess, from a consumer's perspective. It makes you feel perhaps a little bit uncomfortable, you know, that you might be being charged according, you know, by a company using information that you haven't directly given them. Do you think that if this type of model is used, companies have a bit of a responsibility to be more transparent with consumers as well and talk more about exactly how they're actually pricing their insurance, for example, or keeping them in the loop a bit as well, given they are using all this information about you?
Yeah, look, I think the whole concept of data and big data and all of that is one that we're still learning about, and that it does carry certain risks, and the whole problem of hacking and data being used in inappropriate ways. I think our industry is at the early stages of understanding some of those exposures and risks, and other industries are no different. But ultimately, it all comes back to what's good for the consumer, and if we can use that information to give consumers better outcomes, it's inherent in that we are transparent about how we use that information, and making sure that consumers feel comfortable that by having, say, for example, a mechanism in their car, whether it's an iPhone or a little widget that is recording where they're driving, where the car is, and how it's being driven, and the acceleration rates and cornering speeds and so forth. It's very important that the consumer has confidence that by putting this device in their car, that information is going to be used wisely and for their benefit, not to their detriment.
And as you've were speaking previously, you were talking about how pricing can vary so much. If you just use car insurance, for example, how one 22-year-old could be charged a complete different price to another 22-year-old for various things. So using technology and that type of thing, how can that make pricing more fair?
Well, I think what's interesting about the technology and that concept, and this is technology that's readily available at the moment, what it does is that a traditional way of operating is that an insurance company will ask a 22-year-old what type of car they have, what their driving record is, they ask the occupation, and all of that information is a proxy for risk, not real risk. It's just a proxy that gives an indication of what the risk profile might be. If you've got a device in a car that's actually measuring the acceleration rates and the time of day the car is being driven, where it's being driven, what suburbs, all of those sorts of things, you're actually getting real risk information, because one 22-year-old could drive the car very sensibly in one neighbourhood, another could drive it in a very different way in a different neighbourhood at night rather than during the day, and so your profile is entirely different. But asking the questions up front doesn't necessarily get into the granularity of those two different profiles.
All right, okay, John. Well, thank you. I think you've sort of talked about a few, some of these big concepts which we hear a lot about, like disruption and big data, but it's interesting to, I guess, think about how they might be applied to an industry like insurance. So thank you for that.
Pleasure.
And we look forward to seeing what Ando does.
Yeah. Thanks, Janae.
Thank you. So I'm Janae Tibshirani, joined today by John Lyon here at interest.co.nz.